Hello, and welcome back to Helping Healthcare Scale. I'm Austin Hare. Our guest today is a repeat guest. His name is David Phelps. He's the CEO and founder of Freedom Founders, which is a mastermind group of high-income business owners looking to take control of their financial future through alternative investments. David, thanks for coming back on the show.
Austin, it's always a pleasure, my friend.
Likewise. Well, cool. So you did tell your story in depth, but this was several years ago now. And so let's go ahead and just touch base on that. If for everybody listening, if you can kind of tell, because you were a dentist and you kind of retired from dentistry early, but I don't want to spoil it too much. So yeah, why don't you just tell everyone your whole story?
So as I explain to people that know me today as being focused on alternative investments, we'll get into that a little bit. That's not where I really started. Well, actually, I did start there. I started by investing, buying, acquiring my first real estate investment property, if you will, when I was age 22. Now it's going to date me, but that was 1980, 43 years ago, a long time ago, Austin. And I convinced my father to be my joint venture partner because I had no money. I was 22. I was getting ready to start dental school at that time, but I was between college and dentistry, and I just was reading books about stock market investing, which is mutual funds, and I read some books about real estate because I just wanted to be, quote, an investor. I wanted to learn what investing was about. Again, I'm a kid at that point, right? Getting ready to start out, got years to go through dental school. Someday I'll be a business owner, a practice owner, like everybody aspires to be, but I'm always thinking ahead. So I wanted to get ahead, right? Get ahead and understand, well, someday I'll have some money, hopefully. So what am I going to do with it to be a, quote, investor? And so the real estate made sense because it's a tangible object, tangible asset that I felt like I would have more control over. So my dad provided the financing. I was the manager. We split profits 50-50. We split a little over $50,000, holding that property for about 4 years. I managed it, and I took my $25,000 and parlayed that into more properties. And after I graduated from dental school,
can you talk a little bit more about this first property? Like, what exactly was it? Where did you find it? Like, what made it special?
Yeah, so good question. So I went to school at Baylor Dental School in Dallas. And so knowing I was going to be there for 4 years, that's when I told my dad, hey, would you invest with me? And he's in Colorado where I grew up, so he's not even close. But he came down. He actually flew down. I think he came down twice, and we just very, very conventionally found a realtor, and told her what we were looking for. We're looking for investment property, right? So I still remember, her driving us to different locations around Dallas, looking at different things, townhouses to single family houses, a fourplex, different stuff that, kind of made the investment criteria. And we finally found this one single family residential house. It was, not what I would, not the houses I bought after this. This was more stately, in a little bit older area, but stately part of Dallas, 2-story brick. And the thing that made this potentially a good buy is it was an estate sale. So the widow lady who had lived there probably, without spouse for, I'm guessing, 10, 15, 20 years, and probably had lived there with her husband, probably for 30 years, nice area. But the house was dated. It was and it's estate sale. So again, the heirs typically want to divest of property quickly because they just want the cash, right? So put the house on the market. They're not going to fix it up. And this was in 1980, as I said. Now, just to give people context, 1980, we were starting what became back-to-back recessions, heavy-duty, pretty solid recessions. Interest rates, the federal funds rate, which today people think is high at like 5.5%. 20%, yeah, 20% in 1980. Now, that didn't mean mortgage interest rates were that high. They were about 13 to 15%, but that's still way higher than today, right? That's almost 2.5 times higher than today. So credit was tightening up. And take note, because I think we're in that era right now where credit's tightening. So that meant properties that needed to be sold for whatever reason, people were having a hard time financing them. What does that do? Well, it starts decreasing the prices. And so we were able to pick up this house in a good neighborhood, just needed updating. Even though our interest rate was relatively high, the value we got it still made sense. And we could, quote, at least cash flow the property, which is important. So even though we weren't making any big spread on the rent over the mortgage payment, we could still cash flow it, break even. And it was basically a growth play. And as I said, over 4 years, the property
Wait,
just
so
appreciated in the
what do you
market.
mean when you say cash flow break even? What do you mean? Like you had enough extra cash flow to pay for big expenditures when they happened, or was your
No. I mean, well, the
mortgage?
big expenditures we put into the property, and they weren't huge because it really just needed updating. There's no like major mechanicals or things like that, or like structural, but it's mostly updating. So we include that as part of the investment on the front. So you buy the property for X price.
Mhm.
You do whatever renovations, updates you want to. That just goes into the initial investment. Now you're right. You have to have some capital available for things that might break, like a sewer line, or an HVAC, heating, ventilation, air conditioning could go bad, things like that, water heater. Those can come up in an older home. But yeah, so the margin really I'm looking for is enough margin to break even over the normal operating expenses. Mostly that comes up in turnover. Every time you have a tenant turnover, which you don't want with rental property, that's when you have to come in and clean up, fix up, repair, all that stuff, and you lose rent. So if you can keep someone in the property for quite a while, then it reduces those costs. So if at least we could break even on a relatively modest, vacancy turnover. I had 2 tenants in 4 years. That's not bad. It's not my record by any means, but 2 tenants in 4 years, not bad. So average of 2 years, not bad for turnover, and not have any major expenditures, as long as my rent would cover any basic operating costs, little repairs here and there, right? That might come up, might have a little electrical problem, a little plumbing problem, would cover that. And in this case, the mortgage payment, property taxes and insurance, cover that, then at least I'm break even with a little bit of surplus. To me, that was good enough for our first purchase. And I've got more criteria beyond that today, but that's what made this property work for us, that we weren't like negative cash flowing it for 4 years. We were at least breaking even, and then got the growth spurt because we bought it, a time when houses were lower value because of the interest rates and recession, and sold it when we were coming out of a recession. Interest rates were coming down, prices were going back up again because the cost of financing was lower than it was when we bought the property. Does that make sense?
Mm-hmm. Yeah. So actually, I want to kind of take a sidetrack for a second here, because you mentioned the increase of interest rates decreases the price that you can sell houses. And it applies to all real estate, not just residential, but also commercial. And we're having this conversation a lot right now. And the best way that I can phrase it is that you have both headwinds and tailwinds, which is true of any market at any time, right? And it's like which wind is stronger will determine the direction of the price. And so in commercial real estate in particular, using dental offices or healthcare, offices as an example, there are a lot of headwinds when it comes to interest rates. Interest rates are like this huge, massive problem that increases your monthly payments, that'll keep it from cash flowing, that makes it harder to get your debt coverage ratio, which means you either have to charge more rent, or you have to put a larger down payment down to get approved from the bank, or you got to have negative cash flow. Like none of those 3 options are really great, right? That's a headwind. However, they still have tailwinds. And what I mean is specifically, there's a couple things. Number one is the fact that healthcare is like very recession resistant.
Yes.
And it's been doing very, very well recently. It did really well during COVID. And there are not very many, dental offices going out of business, which means that if you want to have if you want to occupy space, you're not going to get a second generation dental office, right? So you're either going to have to acquire a practice, or you're going to have to build a new one, maybe, or convert an existing location. Convert a different space into a dental office, right? So if somebody's already got a dental office, they're not really going to want to be flexible in the pricing, because they know like anybody else who wants one is going to have to go out and build it up from the ground up, right? So that's number one, is like the fact that they are just not going out of business. Number two, which is related, is the replacement cost. And so when you think about how labor has increased over the past 3 years and how the cost of supplies has increased over the past 3 years, well, now you've got a group of people who aren't really going out of business and selling their buildings, which forces people to go and build new. And so now you've got like if somebody does want to sell, you're comparing that cost to the cost of new construction, which is really expensive.
Yeah.
And so there is the question that, I've heard people say in commercial real estate when it comes to high interest rates is how long can you carry the piano? Meaning when you have a lot of, interest, you're using a lot of leverage, the weight becomes heavier and heavier and heavier, right? Like carrying a piano, eventually you just got to drop it, meaning you'll slash your prices. Now that's mostly true for developers who are planning on flipping, and, they have good profits built in typically.
Right.
And it's like, as interest rates increase, they kind of just cuts into their profits. And so if they try and wait to get the price they want longer, eventually like something's got to give. But this is all kind of just speculation on my part. Like, I'm curious, as to how it actually played out back in the 80s, because you said the Fed fund rate went to 20%, and right now we're at
20%.
5.5. Okay, so my question is, I have a couple questions, but number one, like the reason that interest rates are so painful right now is because we came out of an extraordinarily low interest rate period, and so the price of real estate reflects the low interest rates.
That's right.
So I do hear people say interest rates can go way up, and maybe they can, but I think it hurts more now than it did back then because we coming from a zero interest rate environment. Now, is that true? Like, what were interest rates back in the 70s?
No, you're 100% right. I love the context you just laid out, because I agree with you 100%. Yeah, real quickly, and I'll answer your question about the interest rates. But yes, you're talking about what I call playing the long game, an investor versus the short game, which is a flipper. And flippers have done very well up till about now, or the last 6 months when rates have topped out. You're 100% right. And that's why, to your point, knowing what the tenancy is of any building, residential or commercial, makes all the difference. And we're talking about here dental or healthcare businesses, which are very resilient. They're great long-term tenants. So if you're playing the long game, and you know what your acquisition price is, what your debt service is, even if your debt service is 7.5% or 8% today, if you buy right and have the tenant with a lease that will be sustainable with appropriate increases, you're going to be fine. Doesn't mean you shouldn't go out there and do it. Great 100% versus like office. It's cratering for the reasons we don't have to go into, but office is cratering right now. Other segments will also have trouble because the short game players who, as you said, use bridge loans for construction or big renovation projects get caught in the middle of the fluctuating interest rates, and they got in when rates were lower. Now rates have doubled, and they're trying, and their profits get squeezed, and they can't refi, they can't sell. Big trouble. That's where the roll-off happens. So back to your question about interest rates. Yes, people will say over the last 40 years, the average 30-year fixed mortgage rate was 7.78%. So we're just now kind of getting there. We're just getting there. So shouldn't be a big problem. It's the rate of increase from, as you said, like zero federal funds rate, like back March of last year, now rising to 5.5 as of last month, July, is that rate of increase. We haven't seen it historically. It's too fast, and there's a lag effect that people are not taking into account. A lot of the media today is saying, in fact, I just read in the Wall Street Journal, the Fed, Jerome Powell, said just over the weekend, they're not expecting any recession at all. For a while it was like soft landing, hard landing. We don't know. We got to fight this inflation dragon that's got out of the bottle. But now we think we got it covered. We're hitting normalcy here. It's all going to be good. They are not taking into account the lag effect that's still coming. I mean, 6 months, 12 months down the road from the last increase. Well, we just had a increase last month. So that increase won't show up till probably this time next year. The increases that came over the last 6, 9, 12 months are just now hitting. So the Federal Reserve, is not running the economy on a dial like this, where like you're fine tuning it. No, it's like you got a big wheel here and you turn it one way and you can't reverse course. So I think the danger is that they're trying to fight inflation. They're hitting it so hard that there's going to be a fallout, more fallout across the board in the economy is my feeling. So that's where I look at interest rates. It's not like we're just getting back to what the average was in the last 40 years. It's the rate of increase that we're seeing, and the fact that there's still kind of a mania, a speculative mindset in the marketplace, where there's been such a burst of capital that came flowing into the markets, particularly with COVID. I mean, trillions of dollars added to the Federal Reserve balance sheet to placate all the destruction that happened during the COVID lockdowns in 20 going into 2021. Well, heck, student loans are still on pause until October. 3 years of pause on student loan payments. All this is starting to come due, and all the money that people had during COVID, they're stacking it up. They couldn't spend it. They're spending it down, and we're getting close to the end of that. And we're seeing the credit card balances, revolving credit for consumers ticking back up again. This is all not a good sign. Corporations. Well, people say, well, hey, corporations are still doing it. They're showing strong profits because they locked in a lot of low-cost capital when they saw the Federal Reserve starting to raise interest rates over a year ago. A lot of them locked in, and so they're still riding that. But again, they're going to have to refi that debt. This is all coming, Austin. This is coming. So it's not to say just to throw your hands up and go, well, I'm not going to invest in anything. No, I think you have to just be very more critical and discerning in where you invest, how you invest, to make sense out of it. That's the key here. And most people are not that discerning. They just don't understand it. They don't pay attention, or they're following what I call the media groupthink, which I think is going to be in for a nasty surprise. But again, you can ride the wave or you can get pummeled by it, and it's a choice.
There's a lot to unpack there. Yeah, and I agree with, with so much of what you're saying. It's just like, I've been wrong so many times in my predictions, because right when COVID happened, it was like, oh, the stock market is going to go to zero. Like, we never could have predicted March 21st, 2020 would have been the very, very bottom, right? That was just at the very beginning. And then I thought, oh, like, well, the housing recession is coming next because nobody's gonna be working, so they don't have any jobs. Well, I didn't realize how much a rising tide lifts all boats, right? Even states that lost populations like California, the price of their real estate went way up because the entire country was flooded with cash, right? These are all things that are easy to predict in hindsight. But at the time, I was predicting it to get a lot lower. A lot of people were predicting it to get a lot lower. We were all talking about the crash and like the next housing bubble pop and all this kind of stuff. And so, yeah, it's just like, it's not until it's too late that you can really go back in hindsight and dissect what actually happened. And so, yeah, I think like what you're saying resonates. But it's just like, I would have thought when it came to rising interest rates that we'd have already seen like a hard landing, and it's like, it does, what it's hard. I have less conviction. I've been thinking that we're going to go into a recession for a long time, but with every day that goes on, like, I have less and less conviction about it, because it just does, like, and to your point about it takes 6 months to find the effects. Yeah, that's absolutely true. I mean, we were talking with some developers who had the $70 million deal that they put on pause for, a year essentially. And so because of interest rates, like, that's the only reason. I mean, we've been, there's some land that we had under contract, and my partner had under contract, I should say, but they were getting ready to move forward with this multifamily development, and they hiked interest rates real quick, like in 30-day succession periods, and like then that 2-month period where they were trying to finalize all their documents, because it takes a long time to close on commercial real estate.
Right.
They just said, sorry, like, we can't do this right now. And so that's something where all those contract workers, all the painters, all every single person, all the admins, all the stuff that was going to go into that development that they had lined up, like, they're not going to be doing that anymore. And so, I mean, it's definitely all those types of people it's going to affect, and it's going to take an effect on the economy. I guess what I'm still unsure about is just how much, because like, if you would have asked me a year ago, I would have thought for sure by Q3 23 we'd for sure be in a recession, and like, we kind of had a little blip of one, like we had 2 quarters of negative GDP growth, but nobody stopped going out. I mean, people were still spending money. Like, it was a very, very light one. Our luxury Airbnbs are still getting booked. And so, yeah, that's kind of what I'm, playing with in my mind right now.
No, I agree with what we're seeing. Yeah, you go to the airports today, they're just packed. They're packed. Tourism, hospitality, people are taking vacations like there's no tomorrow. I see it. I still believe that we're seeing the tail end of all the liquidity that was pumped into the market artificially by fiscal and monetary policy starting back in COVID. When you mentioned, March of 2020, I think the Fed had to do what they did because I think we would have just spiraled out. So I am not negating doing something, but like everything the government does, and again, it's just government. It's inefficient, right? So and look, still today we have major deficit spending. I mean, the current administration, not getting political, but just, and I don't think it would matter who's in administration.
Both parties are bad at spending.
Both parties are bad. Both parties are just, they're all just spending, and no one's talking about the debt. You remember 8 weeks ago, thereabouts, we had the debt ceiling crisis. Remember, which comes up every few years. It's like, both sides are fighting. We don't want to extend it. We need to have more budgetary constraints. And finally, they get, this time 8 weeks ago, they said, okay, we'll just blow the lid off the debt ceiling cap for the next 2 years, get us past the 2024 elections conveniently, so no one has to get involved with that there. Do you know, in 8 weeks, we've added $1.8 trillion to the national deficit in 8 weeks, Austin? See, this is the problem. This and the Inflation Reduction Act, nothing about inflation reduction. It's really the Inflation Expansion Act, because all of it's pork barrels, it's spending money that we don't have. That is inflationary. So we've got Powell on one side saying he's going to be the hawk and he's going to tame inflation back down to the 2% goal. He's going to get it there. He's not going to be a weasel. So I think he's maintained that he's going to keep rates, up for this year, maybe even another little bump in September. Maybe they'll look at the data and all that they look at, which, by the way, they look at a lot of lagging indicators, which I think, again, it's maybe all they have to work with, but that's what they do. But they keep the rates up. I think there's going to be a harder, stronger roll-off. Now, I could be wrong too, for sure. I'm just saying this is what I see. Why don't you have me back in 6 months? Let's just see what happened. Again, it's just, we can see what happened. And again, it's not about who's right or wrong. I think what we all have to do is we have to look through our own crystal lens, look at data. And I just say, hope for the best, which I'm not a pessimist. I say, hope for the best. Yes, absolutely. But kind of plan for the worst. And so find somewhere in between where you're hedging your bets. You got to hedge a little bit. No one's going to be right ever 100% of the time. Can't be, no way. So we have to hedge a little bit, right? And look more, I think, at fundamentals. And, we were just talking a little earlier about fundamentals, cash flow that will support the tenant base with fixed rate debt. I'm good with that. I'm good. Those fundamentals, rather than being more on the speculative side of just looking at what the momentum has been over the last several years. The momentum has been high in everything, right? Well, I'm just saying the momentum, I don't think it's going to be there. I think we have to go back to more fundamentals. If you look at fundamentals, when you're making your investment decisions or business decisions, you're going to be fine. Just don't let the momentum of the exuberance that we've seen the last few years drive you to make speculative moves. That's my point.
Yeah, I agree. That's exactly what we decided too, is like, I don't believe in just sitting on the sidelines, because then you're timing the market. And then you're essentially saying that, like, I'm smart enough to figure out, when to get in and when to get out, which I don't think I am. And most people are proven to not be. And so what we just decided is we're going to be more strict in our parameters. So like you said, right. Make sure that the deal lines up. So maybe deals that we would have done 2 years ago, we're going to pass on now. And it just means a lot less volume. And so it feels like eventually enough people are going to be doing that it's got to trickle its way down. It's just like, it's surprising me, like how long it's taking. And so, I mean, we're still moving forward. Sounds like you guys are too. And so, yeah, that's why I'm kind of curious. We kind of took a side path from your story, but like what, let's talk a little bit about your investment strategies now. Like we can just to backtrack a little bit, like how did you make the pivot into real estate? And then let's talk about the story of, like, how you founded the Freedom Founders and what you guys are doing now.
So as I said, I took my profit, my give or take $25,000 from the sale of that first property that my dad and I co-invested in. And I took that and I parlayed that into more real estate, primarily all residential, because that's the best place for a young guy to parlay. Commercial wouldn't have even been on the radar for me, but I could do residential. And so I leveraged a lot. But I was looking at fundamentals. I understood, the cash flow game. I had to negotiate. So I added quite a few properties to my portfolio over the next 15 years. I had somewhere around mid 30s, 35 or so. And what I did, my strategy was this, even though
you were 100% owner of 35 residential.
Yeah, 100%. Yeah. Nice. I'm not a syndicator. This is all me.
Well,
but they were leveraged. So what I did is I took excess capital from the practice that normally would have gone into quote savings or like a 401k or something like that, a retirement plan. Instead of doing that, I just took the excess and started paying off like one house at a time, like the higher interest rate house, or the one that had the lower balance that I could pay off to zero faster. I started, it's called snowballing, right? So snowballing the debt. So you snowball one, then you have extra capital from that one, and you start snowballing. So 15 years or so down the road, not all, but a good portion of these properties were free and clear. So obviously the cash flow goes up from that. And in 2004, subsequent to I'm speaking about my daughter and why I just made the shift. My daughter in 1995, at age 2.5, she was diagnosed with high-risk leukemia. She survived it, but it was a horrific time in our lives. Her mother and I didn't make it through our marriage. It was a lot of pain and physical pain and emotional pain. But she survived. My daughter survived that. Then she had seizures off and on, uncontrolled seizures for the next several years. And then age 12, because of all the chemo and the seizure medication, she was in end-stage liver failure. This is age 12, and this was 2004. I'm just going to go speed through this, but it was again another horrific time, figuring out where to go, how to go, get her on a transplant list, all this stuff, and she's vomiting blood, her liver's backing up, can't process. It's just and there's no dialysis. I mean, you don't have a lot of time to figure this out, You know, you can't just go on a dialysis machine like you can for kidneys. Grace of God, another family's child, his life is lost in an automobile accident. My daughter's on the list, you know, and it's all a ranking system. And, you know, you get the call is what happens to people who are waiting on some kind of transplant. You get the call, your already bags are packed. You got to be ready to go. Some angel care flight will fly you to the medical center if you're not living near it, which they were not. And, you know, you receive the liver, and grace of God, you know, the surgeons and all do their best, and, you know, the patient survives. Jenna survived. That was when I really decided, I can't keep doing what I'm doing, you know, especially being the blessing of being as you said earlier, healthcare. It's very resilient. We always have business, but there, I was the guy who had to provide the business. So that was taking me away from the freedom I wanted to spend time with my daughter. So I'm like going, okay, do I keep doing this? What I did, Austin, is I just kind of on the back of a napkin, no software, no Excel spreadsheet. I just figured out how much cash flow do I have coming from these, from the properties. And if I sold my practice, net, how much would I have to put back into real estate, which fortunately I knew how to do. I knew where to put it to get, you know, the same kind of return. And I put that together on the back of a napkin and said, you know what? I got enough for now. I got enough for now. And that's what I call the freedom number today. What do I need to get free or get some freedom to do whatever I want to do, to take my foot off the gas pedal? And I thought maybe I'll take a year and a half off from dentistry. I can always go back. I can be an associate somewhere. I could partner up. I could build another practice. I wasn't afraid of going back as long as I could sustain my family's financial needs during this interim period, whatever that was going to be. Well, that worked. I sold the practice and spent time with my daughter, and then I had this margin of time. And people came to me, started hearing the story and go, well, not why did you leave dentistry? Because they understood my daughter's situation, Austin. But it's like, how could you do that? Because not a lot of people knew I did real estate on the side. I kind of kept that in a side pocket, you know, didn't make a big deal of that. And so these are colleagues in dentistry and medicine who I knew, and just started asking me just organically. And, you know, they say, well, could you show me this? Again, this is a handful. Could you show me, you know, how you did it? And I said, well, I can show you how I started when I was in my 20s, but it's probably not the way you're going to want to do it because, you know, your 40s, 50s, whatever it might be. And you're busy. Your time's more valuable with what you're doing right now than my time when I was single starting this out. So basically, I just had a handful of people just piggybacking on deals that I was already doing. Again, small deals, not big syndication, small deals, mostly, again, single family, easy to put together, easy to figure out. I mean, I could do single family you know, blindfolded. I mean, it was that easy because I had a market. And people knew me. I got deals, right? Which is a key to alternatives is access to good deals, which is what you do. So the small cadre of people who were jumping on my deals, and this is now we're hitting 2008, 9, 10. The deal flow is crazy because we're going through the great financial crisis. And now the deal flows are just like easy because there's no money. Credit crunch. Again, I'm future forecasting what I think we're going to see in this market. Credit crunch, liquidity tightening, deals are going to be plentiful. And so we did that. And then I'm thinking, well, I can't be the supplier to a lot of people. But obviously I'm helping people who want to get involved in real estate, but they didn't want to be hands-on. So how can I scale this without me doing all the work of putting deals together and stuff like that? Because that's a business in itself. I thought, well, I know people in the real estate space. I've been doing this for 20 years. I'll just bring a handful of them to a group, and we'll just have a small group and call it a mastermind, and just see what works. I was the connector. I'm the translator, right, between the two parties. Got investors, high income, high net worth investors. You got business owners who need the private capital. I'll just show them how to put together deals. We started very simply, like my model of equity or debt investing, and then the group just started to grow. It started to grow, and then over time I added, you know, places where more money could flow to with syndications and funds. Because I think you need to be diversified. I love single family, but I also think there's less scalability with single family. So at some point, people want to move to do a higher level, and to do that well by underwriting, vetting, background checks, all the stuff is really important when you're, you know, basically giving your hard-earned money to some operator to quote manage for you. You want to make sure that you're, you know, giving to people who at least have some track record and you think have some experience. So that's how Freedom Founders came about. You know, a little over a decade or so ago, is we kind of became formalized and have grown from there.
Yeah, so many little tangents that we could go off of. So Yeah, I started out with single family. So essentially, when you said you had your market, and people were like, I guess agents or whoever was coming to you, was it in the Texas area whenever they had a
Right.
distressed property that they needed a buyer for, and they knew that you would pick it up?
Yeah, for me in my own portfolio, this is North Texas.
Mhm.
And even specifically, really more specifically in the area where I had my practice, when I started way back in the early 80s, is I invested time, not outside my practice, in meeting all, we call them the movers and shakers in a certain community, right? Or a
Yeah.
certain locale. It's like a farming market. So I would meet the local bankers, the real estate attorneys, title companies, real estate agents, brokers, property management, CPAs, right? So you start to kind of get involved in the what I call the quasi real estate financial arena. And when they knew that I was a buyer at the right price and or terms, then I got deals were brought to me, because I would, if I could, I would figure out a way to put a deal together that met my needs, but also meet the primary needs of a motivated seller. And that's who I became in, again, a small market, right?
What? Yeah.
And that's the advantage of being, like a small fish in a smaller market. You can stand out, and again, that's not something I could scale. I'm not big enough to scale that to, nationwide commercial stuff but you do the same thing. You've got a network. It's just, more vast, but you build a network, and that's what most people don't have when they want to get involved in real estate. It's like, okay, they want to do it right, but they don't have a network. You've got to connect with people who have a network, and then you find out where you can fit in to whatever your goals are.
What kind of returns were you generating? Like, what kind of percentages? Like, do you have like an average, like, deal size back, I know this is a while ago now, but like deal size and returns you got?
Well, you mean when I was doing it personally?
Well, yeah, when you had 36 and when you started to like get more.
Oh gosh, yeah. I mean, hard to say, but I would say with the leverage I was using. Now remember, I was putting my time into this. So a lot of people, when they look at returns, if they're doing it, they're not putting their time in.
That's
so
a great point.
When I say I was getting 30% plus, remember my time. So probably whack that in half.
Yeah, if you hired somebody to do the job you were doing,
then probably somewhere around mid-teens. Would be
really, half that was your salary, right? Like for your time. The other half was the return on capital.
That's right.
Okay, and so then when you started bringing people in, how did you structure? You mentioned the investors and business owners. Like, how did you structure the GP LP split? Like general partner being the sponsors or the syndicators, and the limited partners being the investors. How did you guys sponsor those? I mean, how did you guys structure those?
Well, okay, so two parts. When I was very organic, just with a handful, I'm talking about 5 or 6, that before we even have kind of the community, those were simple. I structured those either as debt investments, so they would just basically provide the capital, and I would just give them a stated return,
12% or 15%.
Yeah, well, here's what I did, because I'm a longer term investor, so I'm not a flipper. So I couldn't cash flow 12%. So what I would do is I would like give them 6% interest only payments, but give them an equity participation on the backside, which is kind of typical of a syndication day, but this is not really a syndication. I'm doing one-off properties. So 6% cash return, which I could cash flow that, and then give them the back end. We were buying cheap. So they made easily 12, 13, 14% on their money, 6% now, but the rest of it on the back end. And I did fine, because I had a little money in the deals. I was the doer, right? The technician.
Back so that's referring to when you sold it.
Dude, I'm talking about, I'm talking about, writing mainly like the 2008 on up to 15, 16 right up. That's how I did it. But I'd structured some deals also as equity deals, which means, again, you just split the cash flow and you split the back end, which is safer for the operator. But in that market, the
less
investor actually made more, but it's safer for me. So the basic deals, syndications though, as you do those now, I don't do syndications. I don't do any splits with anybody in our community. I'm a connector and an educator. And so people I know, or I get referred people who are operators that can do the bigger syndications or funds. Well, we have a whole vetting process to number one, I have to know them, or somebody has to know them that knows me well. Then we just do a heavy background check. We dig deep into their financials and because I need that too, because that's how I invest today. I don't go out and find my own deals anymore. I'm past that. I don't want to do that anymore. Been there, done that. No, and nor do the people who are part of our community. These are not people who want to be active on the street. When you're younger, I think it's a great place to be. If you got time, go be active and learn some stuff. And then over time, you'll probably grow into be more of a passive investor. But the whole thing, Austin, requires, I think, the diligence and desire to become more financially an advocate of your future rather than what I call abdicating to, the Wall Street financial markets, which is where most people go. This takes more work on the front end, but gosh, you have so much more control and you can see your future more clearly than you can, oh, how much is enough with my 401k or whatever. That's where I think people run into trouble and that's why there's so much uncertainty about, do I have enough to quote retire, sell my practice to a DSO, bring in a partner, an associate. There's just no clarity about that. And we give people clarity because they can actually see and measure how they're doing with income replacement versus just piling it up and hoping they have enough.
Yeah, I like that. So yeah, let's talk then. I know that you have strong opinions about 401ks and that sort of investing, and so there's a lot more control when it comes to real estate. So what was your experience with like the traditional kind of, I don't know, 401k, Roth IRA, post retirement kind of investing?
Yeah. Well, so back in the 90s, I've been doing real estate at that point probably for 15, 16 years, was seeing the results of that, which was a good thing. But I also felt a little guilty because everybody else, all my other friends in dentistry, were signed up with some people or financial advisors, money managers, that kind of people who were, helping them get set up with their office 401ks, right? And I'm thinking, gosh, maybe I should be doing that. So, I didn't have more than 15 years of a track record. And I still felt like, well, maybe there's a hole in my bucket somewhere. So I jumped into that too for a few years. And after having my own 401k, administered by, the administrators and the managers, and putting that money, in every year, like they tell you, and getting the tax deferral, which, I get that. I'll talk about that in a minute, but the tax deferral portion. And yes, you can have a Roth component. And I'm not negative about a Roth. And there's ways to build a Roth up. I'm just going to talk about traditional non-Roth here for a minute, the traditional tax deferral. I did that for about 3.5, 4 years. And I just looked at it and not that we had any bad market during that time, but I just realized I wasn't getting nearly the returns that I could get in real estate. So I shut it all down, terminated it, everybody got their money rolled over to traditional IRAs. That's how I ended up with a traditional IRA, which I later converted over a period of some years, converted to a Roth. And that's a strategy I'll come back to in a minute for those who have 401ks or traditional qualified retirement accounts. I'm not saying it's a bad thing, because again, I got sucked into it, and most people do, because it's all about, well, I got to save taxes. I'm making money now, and darn it, I want to pay taxes. So your CPA unintentionally, well, I guess intentionally, but not meaning to give you bad advice, because the standard advice is whatever he's going to give you. Do tax deferral, because you get the compound effect. You're not paying taxes every year. But here's the downside. There's several downsides. One, you're locking up your money in that qualified account, simple, traditional Roth 401k till you're 59 and a half. You can't take it back out. So you've already said, well, I'm not going to retire until I'm 59 and a half. I have people in Freedom Founders who are at age 42 who have done really well and actually taken some exit with a DSO or taken some multiple, and they've got some good money, but they've got so much that's still locked up in a 401k, they can't touch it without taking a big hit on the penalty. So I don't like that.
The penalty?
The penalty is 10% plus then the tax. I mean, you could do it. And I guess there's probably there's a mathematical reason you could look at to do it. But see, I think if you're an entrepreneur, which I would still classify most dentists who go into business as being entrepreneurial. I mean, that's why a lot of people do it. Not everybody wants to be an owner. I get that, and that's fine. But those who want to be owners, you go do that because you want to have some control over your business, your practice, how you treat people, the whole thing, right? I mean, that's kind of the fun, the challenge of it. Then why don't you want to do the same thing with your money outside of your practice? And I get the same puzzled look. Well, because that's why you have a 401k. That's why. Okay, but gee, if you want to be in control of your own future, don't you want to be in control of your finances? Well, it's too hard. Well, I don't have time. Well, you do if you want to make it a priority. So that's one downside. Secondly, let's think about taxes, tax rates. Just between you and I mean, we could probably agree that tax rates are probably going to go higher, not lower. That's my feeling. I don't see with the debt we have in this country, with entitlement spending, I don't see how taxes will go lower. I think they will go higher. Now, if that's what you believe, understand that when you take withdrawals at the appropriate time from your traditional tax deferred account, those withdrawals come out and are taxed at ordinary income tax rates. Ordinary income tax rates, highest rate of tax there is, and will only stay high. I think go higher. Another reason is you don't get any benefit of investing like we do in tangible assets. Your business, real estate, in the growth component, we get long-term capital gains treatment, which is about half what the top rate of ordinary income rate is. So if you own what you can own real estate in your tax deferred retirement account, but you don't get any benefits of cost segregation, bonus depreciation, capital gains, long-term capital gains treatment. You don't get none of that. It all gets converted to ordinary income. Just lost all that if you want to do that in your account. Another reason is you're familiar with, I'm sure your listeners are familiar with the fact that with capital assets, when we die, when we pass away, our heirs get what's called a stepped up basis, which means that they don't have to pay tax on the gain that you had while you held the business or the real estate or the stock or the bond. They get a stepped up basis. If you have that inside of your IRA, which a lot of people will have, stocks, bonds, mutual funds, etc., that all comes out. It's taxed at ordinary income, just lost the stepped up basis completely. So it's terrible for generational wealth transfer. Those are some of the primary reasons I don't like the tax deferred vehicles. But as I said earlier, there's a way to make up for that. And I'll just be very quick about this. You can take your traditional and convert it to a Roth. They tried to change that rule a year ago and remove that, but you can convert to a Roth any amount you want to. And you just only have to pay the current tax on whatever you convert. If you convert to a Roth, now you have that money in a account today, at least, that not only is tax deferred, but also the withdrawals come out tax free. Now, I think they're going to probably means test that in the future, so don't load up too big. But that's one way to
means
better
test, meaning average it out.
Means test meaning you've got so much net worth, you've got so much income. We're going to tax you to some extent on that Roth that was supposed to be tax free. But look, they're means testing everything right now. Social Security means test. I'm on Medicare, believe it or not. I'm on Medicare. It's means tested. Trust me. I pay at the top level. It's not cheap. Okay, so the better you do in life. Unfortunately, we're becoming a more socialistic environment, society. Yeah. And I'm not saying we shouldn't be helping other people that don't, but it's wealth redistribution, and it's what it is, and it's not good in the long run. There are places where we need support, but you're going to be means tested. So you do really well in life, and I think a lot of the benefits. Well, Social Security is going to get means tested. I guarantee you. Those that I'll be able to start taking it in 3 years at the highest level. But sometime before I die, they're going to means test that too, and I'll probably get taxed a whole bunch, or they'll reduce it. I mean, it's coming, Austin, just like higher tax rates. I mean, you have to be more self-sufficient than ever before and not rely on whatever the government says the rules are today. They will change them, I promise.
Yeah, no, that's a good point. All right, so specifically what we're talking about is taking essentially stop. If you are investing, or you have been investing, a lot of what you talk about in your group is stop investing in these retirement accounts that you get penalized before you take it out. If you have, and let's start doing alternative investments. Now, if you have invested a lot in them and you do want to take it out, or can you convert that into a self-directed Roth IRA? And then is there penalties for that? Do you know?
No, there's no penalty if you want to convert from, let's just say, wherever your custodian is right now, and it could be as simple as a Vanguard, a Fidelity, Schwab, all fine, right? You can move that money to a self-directed custodian, of which there are a myriad in this country, which then allows you to invest we call self-direct into all the other alternative investments that we've been speaking about. And you're not just limited to the menu of your 401k administrator who gives you kind of some mutual funds and things like that. You can go into alternative investments that as you wish. Now, as I said, also you can convert to a Roth at the same time, also self-directed, but that just takes you out of the current designation of being taxed on withdrawals when you're 59 and a half, again, under current rules.
Okay, so generally when people come into your group, the first thing you guys talk about is like, hey, stop investing in these Roths and these or whatever, these 401ks and these IRAs. Hold the money and invest them, in alternative assets that, yes, you may subject yourself to taxes, but that's really the only benefit. And even then, there's a lot of advantages and ways to get around paying top tax in the top tax bracket, because you can do cost segregations and you can do 1031 exchanges. And so, yeah, is that kind of like the gist of some of the things that you talk about?
That's my model. I never tell anybody what to do. I don't tell them, but the social proof,
give options.
Yeah, we have options. The social proof and the education, I let people, they make up their own mind. And most people that are part of our community, yes, in time, first few months, 6 months, they are terminating, just like I did back in the 90s, their general 401k, cash balance plan, whatever they're doing, and getting control, not taking receipt, but getting control so they can self-direct it, until which time, after 59 and a half, then if they want to take distributions, they can do that. But at least they're putting it into other investments that they're feeling more comfortable with, because that's really what we do. It's what I call proximity to your investments, being closer to your investments than Wall Street. Wall Street, you're separate from that. You don't get inside the boardrooms, right? You just get the financials from your financial advisor. You just kind of have to go on the whims of whatever they think. I like to be closer to the investment. I like to see the property, know the property, or at least who's managing it and that kind of thing. That's just me. And I know that's what you do as well. I mean, you're helping people, invest in real estate that is tenanted by, healthcare. It's a strong marketplace, right? But it takes knowing somebody and understanding what that model looks like. But I just like that better from a control standpoint, because I know I'm going to see that through ups and downs of the economy. And I think long term, those tangible assets are going to mitigate the inflation. I think we're going to see deflation for a few years, and then we're going to see inflation for the long term. So we're going to have this dip, probably some deflation in assets, because we've been in a bubble. But long term, there's no getting out of this inflation. I think we've tipped over into that side, and we're going to see inflation here on out.
Yeah.
Well, we have to. They have to monetize the debt, and that's through inflation.
Do you hold any individual stocks or no? All real estate?
Zero. I did some 15 some years ago. I'm completely out. That's just me. I'm not telling other people you should do that. That's just me.
Well, no, I have a lot of individual stocks actually. I'm mostly real estate, but I do like holding the individuals. Like, COVID was great, took a huge hit. Now I'm getting back, close to the highs lately. But it is. I like the whole mutual fund idea. Like, I've heard so many bad things about them. Like Tony Robbins talks about it a lot. It's just like, yeah, you look at any one, take any one like at random, and it's like 95% underperform the market, right? So you're essentially 5% probability that you can pick the one that outperforms the market, right, at any one given time, because it also changes. The 5% that outperform one year might not be the same, and in fact usually aren't the same 10 years later. So I think we are in agreement about that. Now back to real estate, we talked a little bit, you mentioned you're doing a lot of debt financing or investing in debt funds. Can you explain why? And then, well, first of all, explain what that is, and then secondly, why you're doing that?
Yeah. So in what we call the normal retail market space, there's institutions, there's banks, institutions that do retail financing. And especially when rates have been low, as they have been for, the last 15 years, then using banks for long-term financing makes sense. Even today, even with higher rates, long-term financing, if you buy right, even at 7.5% or 8%, I mean, it can make sense if you get fixed rate and all your costs are covered. We talked about that earlier. So that's the retail market that most people know about. You go buy a house, you buy an office building, you're going to go to the bank to get your financing, to use the leverage, which is the way you acquire and build wealth. But understand that there's a whole secondary market, which I would just call private capital, that's needed, because the banks, institutions have what I call a buy box or a lending box. It's got criteria, right? They have to have criteria. And so there's a whole element of the marketplace out here that's not served by the institutions. So a lot of developers, a lot of fix and flippers, and people who are operators on the street in the alternative markets, they need access to private capital because it's fast, it's easier. They're not going to use private capital long term because the rates are going to be higher, but to let them get in the game. If you're making deals in a marketplace that's turning quickly, where there's deals, you can't wait to go to the bank and get an appraisal and inspections and all the stuff that the banks can require. You want to get the property, the asset acquired,
waiting on banks,
and then you do what's called, then you do what's called stabilize it, right? You stabilize it. It means the bank institutions want to see a tenant or a certain occupancy if it's a multifamily or a self-storage. They want So you get it stabilized, and then you go refi out with the institution, take out your private capital investors. So there's a private capital marketplace for people like us to put our money in. And instead of owning the equity piece, the ownership piece, which is usually where we want to be when the market's going up, when the market's going sideways or maybe going to a correction mode, I'd rather be the bank. We can still earn double-digit returns, but we're the bank. It's a lot safer place to be than in the equity space because we got the margin. We never loan 100%, right, on property. We might loan 70, we might loan 65, we might loan 50% because we don't want to be top heavy in the equity space. So debt is a place to be. I think right now in much more heavily than the equity space where we've been in for the last 15 years. It's a shift in the market. So there's syndications and funds that focus on that very element of bringing private capital to operators.
I'm kind of thinking the same thing too. Is like we saw such a quick expanse of the real estate and a lot of these assets that I can foresee a future. I'm trying to shift my thinking into probabilities rather than definites or definitive outcomes. And it just seems like there is a slightly greater probability that we'll see a flattening of real estate increases, like a plateauing of real estate prices, rather than them to continue to go up because they just went up so high so fast. It's kind of like we went in and pulled some of those gains from the future,
exactly,
into the present. And so,
yes.
yeah, so I've been thinking about these things too, like because I'm doing short-term rentals and event spaces and doing syndicating for stuff like that. And it's like, weighing the ownership of the business part of that, those deals versus the real estate part. And it seems like the business part has more upside right now. So I think it's interesting that you're doing that. So yeah, there's like there's so many things that we mentioned talking about, but we didn't even get to because we went real deep, which is great. So like we're kind of coming to the end of our time, and this has been really fun for me, and I really enjoyed it. And so, is there anything that you want to talk about that we didn't get a chance to talk about yet?
Let's see. We talked about a few things on the front end. No, I think we covered a lot of topics that are probably relevant to our respective audiences. And I would just I'd go back and say we talked about this earlier that healthcare, which is a lot of our audience, that is a resilient place to be as far as a business owner. That's what I call your plan A. So investing outside of your plan A, outside of your business, is something we all want to and should be doing. However you do that, but I wouldn't let the carrot of some outside ventures take the place over focusing on the business aspect. Your business or a similar business housed by real estate, that's a great step into the arena of investing in real estate because, again, you've got a control factor there. But as you become more sophisticated, you can, through connections and access points through other people, you can, expand your investments into other alternatives. Just, do it step by step. I would just caution people today about going out and doing it by themselves, just because the market's been very, very kind with tailwinds to a great extent. Big caution, don't go do right now by yourself. Plug in with somebody. And I'm just looking right at you, Austin, who understands the markets and can help you do something in real estate that might make sense for you. And that's my only caution, is just get help from people who have experience. Yeah, no, that's great advice. So anybody listening that wants to get in touch and find out more information about what you guys do, what's a good resource for that? freedomfounders.com. I've also got, YouTube channel that I put out a lot of blog posts, video blogs. I've got a podcast, The Dentist Freedom Blueprint podcast, which is not just focused for dentists, but I call it that because I still am one, and that's my affinity group. But it's viable for anybody who's entrepreneurial and wants to learn a lot about finance, investing in general. So those would be some places to connect. Great. Okay, well, this has been awesome. I guess we'll have to check back in 6 months and see how our predictions fared out. Let's do it. Yeah, it would be fun just to see where the market is, because again, we don't know for sure. And so it might be fun to come back and just talk about what's happening in 6 months, and then we'll project again what we think is going to happen in the next 6 months and see how right or wrong we are. But yeah, there's ways to navigate any market cycle, and no one's going to be perfect at it. But it's just like, how do you try to thread through it without getting bumped around, and shoved to the side, and that's what you don't want. Yep. Well, thanks very much, Austin. Always a pleasure. Thank you.